Most traders already know what they should do. The problem is they don't follow it consistently. They enter trades without a plan. They move stop losses emotionally. They overtrade after wins, and they revenge trade after losses. And eventually, emotions become stronger than their rules. In day 2 of the mid-year trading reset, we're going to break down one of the biggest problems traders face: execution over emotion. Because the market is not just testing your strategy, it's testing your discipline. Today, we're going to talk about building rules you can actually follow. And this is all based on the option chain, controlling emotional decisions, risk management, and how disciplined traders survive volatile markets. If your emotions are controlling your trading decisions, then this session is for you. Day 2. Let's go. All right, we live. Okay. All right. Day 1 was all about, mindset shifts, getting our mental house in order. Day 2 is the mechanics. We got to have rules for our mechanics. Does that make sense?
Yes.
All right.
Yes.
Let me pull my board up here. All right, we're going to be building our rules and strategy and framework. Today's focus, we're going to define our position sizing and trade cost. We're going to set our entry, exit, and expiration rules. We're going to learn a little bit of how those Greeks work. You always hear people talking about the delta and the theta. We are going to build awareness of our risk versus reward setups. And then we're going to strengthen our discipline. We did this yesterday. Strengthen our discipline and anchor those rules in there. We're definitely going to get that. That is going to be a very, very valuable piece that you're going to need. So by the end of today's session, you're going to have your personal rule book for option plays, clarity on how much you spend per trade, a process for choosing expirations and exits, awareness of how Greeks affect your trades, and a stronger foundation for consistency. Question 1. Are we ready? We got our notebook, we got our pen, we ready to go?
Ready to go.
We're ready,
Remember,
David.
we're not just looking, we're not just listening, we are writing. That's why we're here live today. What is your rule for your position sizing? What does that mean? This is similar to yesterday when we was talking about how much money you was going to spend for your account. So if you said 20% of your account and that 20% was 20K, you got 20K to invest in options. Now out of that 20K, we're dialing a little deeper. How much of that are you putting in one trade? This is going to be your rule here. Position sizing. How much money do you want to allocate per trade? You can do a percentage or you can do a dollar amount, but you want to establish that. And I always say that's important because when you get into your options chain, you need to stay in the area that your numbers align with and that you can also afford. Because that option chain gets busy. So the dollar amount that you want to spend per trade. Keep in mind, if you are dealing with big companies like Meta, those are going to be a little more expensive. And if the money you're trying to spend don't align with those, then you probably don't even want to look at them. But go ahead and give yourself a dollar amount. Now with me, I like to stay in that 1,000 range. If I put money in a trade, let's say if I want to do 2,000 per trade, I could either do one contract with 2,000, or I can find a play that I can stretch that 2,000 and give me two contracts. But I'm willing to put 2K in this trade. So how do you want to divvy it up? You want to divvy up that 2K in one contract, two contracts, three contracts, but no more than 2K in this play. That's what we dialing in here. So yeah, some examples like I just mentioned. If you only want to spend 300 or less per option contract, if you only want to do a percentage of your account in that play, just get those numbers down. Like I said, me on that note, I like to work with a fixed dollar amount. I'm gonna put 2K in this play. I'm gonna put 5K in this play. Do I want to put 5K in this play with one contract, or do I want to put 5K in this play and try to do three contracts? But I'm only putting 5K in this play. We writing? Writing
Yes.
is inviting.
Writing.
Yes.
All right, we're going to move on to question number 2. Entry rules. What are your rules when entering a play? And basically, this has to do with all the technical triggers that's out there. Many different ways of looking at entries. Everybody has their own set rules. Some people out there just freestyling, going off emotions. But if it's at the 52-week high, is one of your entry rules, hey, we'll only get into play unless it's 20% off the all-time high, 20% off the 52-week high. What are some of your rules when entering a play? Whether it's technical or fundamental. What are your go-tos? You want to write that down. Maybe you like a specific RSI. You don't want to get into a play unless the RSI, is below 40, above 50, if that's something that looks good to you. Maybe you use the alligator method, and you're not going to get into the play until that candle closes above the teeth. That could be one of your strategies. If you use the Bollinger Bands, you might not go into an entry until you see those candles touch that bottom trend line. What are your rules and technicals before you jump into a play? Now, for me, it used to be 15% off the high, 15% pullback, and then RSI. But since I've learned charting and technicals, I kind of have other rules in place now. Those still apply, I like a nice pullback. Just depends on what the stock is. A good pullback is going to make it more affordable. So, like I said, I like a good pullback. I'm looking at the MAs now. The 10-day, the 5 moving average, the 10 moving average, the 20. I like to look at that. I'll look at RSI if I'm running a play that is under the 200 MA. Now, experienced traders, they'll tell you do not mess with anything under the 200-day moving average. But I will trade under the 200-day moving average. That's just me. But the reason I'm doing that, if I do that, I'm looking at the RSI at that time. Anything under 200 and the RSI is probably up under 20, I might run a play. Because in my mind, it's pretty much exhausted. There's no buyers in there. There's also no sellers when you get that low. So if any buyers step in, the stock is going to go up from there. And I'm just looking for a momentum. It probably still won't get above the 200, but I can make some money from where it is now to probably another $10, $15 move and take me some profits. Because at the end of the day, that's what I'm here for. Looking for profitable opportunities. All right, y'all got your entry rules down? You got something wrote down. It's so many. You probably gonna have to brainstorm on this a little more. If you've actually been active in the game, you probably done did trial and error on things. So don't take that lightly. Like I said, write something down now. Depending on how long you've been trading. If you're new, you hadn't even dabbled in yet, yeah, this probably doesn't make sense to you. But keep this question in your bag because you definitely need to address it. All right, we're going to move on to question number 3. Exit rules. You got into play. Now you need a plan to get out of the play. When do you take profits or cut losses? Exiting is more than just taking profits. Sometimes it could be a bad play and you need to get out. You got to make yourself get out. You got to cut those losses. That's difficult for everybody. It's difficult to see a play down 75%. And some people 75% could be 15,000, 20,000. And all you're looking at is if I cut my losses and sell now, I'm about to lose 15,000. I can't get it back. But on the flip side, you still might have 20,000 left to play with. So you down 15, but you still got 20 in the play. That's what he's talking about. Cut your losses, preserve capital. Yeah, you lost that 15, but you still got 20 right here, right now. Don't let that 20 go because you're being stubborn. The play doesn't look like it's going to turn around. Let's preserve that capital so we can put it in a new play and work towards getting that money back that we just lost. Exit rules. What are some of your exit rules? That's the number one thing about exit rules. Yeah, you want to take profit, but you also want to be in a position to cut losses. You hear Trap talk about this all the time. You got to have a risk tolerance. Are you willing to let the play go all the way up and be down 75% before considering getting out? Or if you got a low risk tolerance, man, I'm only willing to give up 10% and then I'm gonna get out of the play. You probably do that 3 or 4 times the way some of these plays move, especially with that liquidity grab stuff we was talking about yesterday. Who was that yesterday? Everybody chimed in. She was 200%.
Right
You
here.
call today?
Yeah, right here, Nisi.
Miss Nisi. These are your rules right here.
Yep.
We would love for you to share how you feel right now based on that conversation yesterday and what we're talking about today.
Well, I sold two of the contracts and I kept one.
Kept one, okay.
And I'm gonna just keep an eye on it for a little while, see what's going on, and if it's a little too tricky, I'm just gonna get out. But couple of the trappers in Patreon early on were like they're seeing Apple going to 280, so I'm kind of using that as my barometer on there. It's been a couple of people, and anyway, I'm just gonna check it out for a couple weeks here and see what goes on with it.
So were you still over 200%?
Mm-hmm. Yeah, like I got up to like 208 today, and then I didn't get out till I ended up getting out like 201. I was like, yeah, let me not just play around with this. Let me just sell 2 contracts and then keep one. So yeah, that's what I'm doing. So I appreciate everybody's input yesterday. It gave me a lot of insight, and definitely what you're talking about right now for sure is spot on. All of it is really we all need it for sure.
That's good.
Yeah.
Like I was saying yesterday, the strategy I ran with the Walmart, I went in with 3 contracts and I knew it was going to at least get 200%. So I said at 100%, I'm gonna sell one, 150%, I'm gonna sell the other, and then I was just gonna let the other one ride. And it did get up to 200%. I could have sold it and got out, but I did have a lot of time on it. So I kept that one running. It did hit the 200%, like I said, and then I would have made all my money, but I kept it and let it run. But it ended up falling all the way back down
Yeah, you were
to
saying
where
that.
I got in at.
Yeah.
So, hey, I bought 2 more. And it's like I never left the play, but I was already sitting on the profits. I got a hand raised right here. With that Bree?
Yeah, quick question. On the example, the third bullet, it says I will roll my contract instead of holding past expiration. Is that saying that you want to get past expiration, but before expiration happened, then you just roll it? I just want to make sure I'm understanding that correctly.
Well, that's one of those strategies. If you're down, you hear a lot of people, man, I should roll this play.
Yeah,
But
I
keep
guess
in
that's
mind,
my rule. I don't roll, so that's one of my rules. I won't roll anything. I just take the loss and go somewhere
yeah,
else.
keep in mind, rolling is accepting a loss, and then what's left over, putting it into a new play. It's just a 2-step process done in one transaction. But yeah,
Yeah,
you could sell the loss, let the
yeah,
money come back in your account, and then do something else with it or get back in the same play.
gotcha. Okay,
So
thank
yeah,
you.
it ain't too many things I would roll.
Yeah, yeah, thank you.
All right. Exit rules. Exit rules. All right, we're gonna move on. Move along to question 4. Now I get a lot of questions about this one here, expiration, because in Trap's course, he don't really specify how you get your expiration. But basically, this goes back to what type of trader you are. We discussed that yesterday. You're a day trader, leaps, swings. That's really how you determine your expiration. And I look at expirations also based on how much money I want to spend. Because the farther out your expirations, the more expensive the contract's supposed to be. Belina, all of the above, I get it. But yeah, expirations. Now, if you just new and don't know what's going on, and when you go in the options chain, I always tell everybody just start looking 6 months out. Because Trap already taught you how to get your strike price. So everybody's doing the math. Now they got their strike price. But when they get in the option chain, like, oh, wait, what expiration do I pick? Just start 6 months out. If your strike price is 70, count from today, 6 months out, then pull up that month and look for the strike 70. See what the prices are. If you like what you see, execute. If those prices don't work for you, remember the farther out you go, the more expensive they are. So now 6 was too expensive for you, back out, go to 5 months out, pull up your 70 strike, see what the numbers look like. That's how I really establish my expiration rules. And I'm so cold right now, half of my expirations have been 2027. But that's another story. But swings, at least 30 days out. Now here lately, when I'm doing shorts, I do at least 30. That 1-2 day crap, no, I'm not with that. I saw you do one, Belina. I saw you do a 3-day. But yeah, I'm at least do 30, even though I don't plan on being in it that long. I'll at least do 30. But for the most part, I'm doing those long ones. Everybody got something wrote down? All right. Question number 5. The Greeks. Do the Greeks scare anybody? That's where your
No,
money at.
I mean, we pay
Yep.
attention to those though.
You been paying attention?
To the delta and the theta, that's pretty much mostly what I focus on.
Yeah. You know, that delta is that probability of when the stock moves $1, whatever that number is, that's what you're going to get per contract.
Mm-hmm.
Theta is your time decay. So theta is constantly eating away at your contracts. So with that being said, your rules here is when you're in the options chain and you're looking for a play, what type of delta versus theta are you looking to get into? You hear Chris Sane say he like deltas above 80. And he's always in the money on most plays. Now me, I like a delta of 50 or above. Will I go lower? I will. It depends on the stock and what the play is. But I like to start out at 50 or above. I don't have to jump right in at 80. 50 is good. 45, 50. I like to start there. But then if I see something in the options chain that might spark my interest or the numbers will align with the amount of money I want to spend, then I might go lower. Now I'll do a 20-cent delta, 25-cent delta, but best believe my theta got to be like 1 cent. And if you're really paying attention to your option chain, some of those thetas, man, they be 15 and 20 cent. And then your premium, your delta is like 30 cent. You need that stock to go up immediately in order for you to make some money. Now, is everybody aware that theta comes off daily?
Yes.
All right, that's another thing.
No,
Yes, just
I'm not
faster
100%.
acceleration.
I'm so sorry.
Go ahead.
I'm sorry. I'm not 100. I understand the delta, the theta. I'm not, like you just said, the theta might be 1 cent and you'll get a delta that I think you said 15 cents or something like that. I'm not familiar with how that worked. Can you kind of walk me through that again?
All right. So, like I said, that delta, that's what you make per contract as the stock goes up per dollar. The theta, like I said, it comes off daily. So whatever that number is, if your theta is 5 cents, that's going to be 5 cents times 100. And that comes off daily. So like with Nisi, when she was at 200%, her play is profitable and she's above 200%, but Apple is always consolidating, which means it's not moving. So she got it at 200% and just sat there, but each day, depending on what the theta was, she was losing value every day.
Okay, that makes sense.
Now,
Thank
if
you.
you're in the red, it's hell to get out. You don't really see it when you're in the green, but when you're in the red, let's see if I can pull something up here.
How many screens you got over there, man?
Hey, working the system. Can y'all see that? Can y'all see the screen?
Yes.
Yeah.
All right. This is Meta. So my computer doesn't slow down. I just screenshotted this right here. Blow that up a little bit. All right. So this is my option chain for Meta. And for example purposes, I pulled up 36 days out. So November 7th expiration, and we can pick any of these strikes based on how much money we want to spend. So these are my columns here. my open interest, my delta, my theta. So all this right here in blue is in the money because, can you see it? You can barely see it. The current stock price is, okay, there you go. The current stock price is 726. So all this is in the money. All this here is out the money. Out the money is supposed to be a little cheaper. Now, rule of thumb, everybody just looking at this options chain here and playing the way Trap taught you, which strike price would you pick?
750.
Highest open interest.
Open interest.
Which strike price?
750.
750.
Yep. Yep.
Yep. And that's because of the open interest.
Yep.
Now, what if you didn't want to spend that? You're not going to get into play at all?
You can check a different expiration date.
Yeah. Yeah. But you 36 days out, so it'd be less than that.
So with some of y'all rules, are y'all confined to only picking the highest open interest? Because I like
Not
November. I
necessarily.
like November 7th. I might not want to come out. Like you just said, we could pick a different expiration. But I want these 36 days out. But this is the best open interest, but I don't want to pay that. So what you gonna do next?
Guess just look for the next. Look for the
Me-
next one that you think is.
Yeah, me, I'll go shopping right in here. Now, Joshua yesterday was talking to y'all about premiums. I have mine set up where you have the high and low of the premium right here. See that?
Yeah.
So this is the highest amount that has been paid in premium for this strike price. And right now, the premium is the low 35.80. Does anybody know our
Yeah.
math rule for making sure you're getting a good deal on your premium?
Well, divide by the high, divide by 2.
Yep. So let's just say
That ain't bad, huh?
we picked that 730. The high is 52. So if we divide that 52 by 2, that's 26.
Yeah.
Right now, this premium is 37. So it's higher than 26. So in my mind, I'm not getting a deal. I don't want that.
Yeah.
Everybody understand that? Because premium is just like stock price. You don't want to buy your stocks at the all-time high. You don't want to pay a premium that's close to the all-time high. And this is the all-time high of the premium. So I need a little room so I can go back up with profitability. Could I get in here? Yep, 37 to 52, but 26 to 52 is much better. So if I can't get the premium at that price, then I don't need to get in here. Or you just wait on it. You can set a limit. Hey, 26 is value. 37 is not value. I'm not getting into that. I'm gonna set a limit order for 26 and wait for it to come down. That's how I play the options chain for my premiums.
But you would keep your strike the same strike you wanted. You just change the dollar amount in the limit to that 26.
But yeah, like I was asking you guys, based off trap rules, which one would we get in? Everybody said 750.
Yeah.
Because of the open interest. And I'm like, what if I don't want to pay that? So let's do that one. It has the most open interest. Let's see if we had a discount. So what's that? 45.27 divided by 2. 22.63.
Mm,
See, that's not on sale either.
But you just put that 22.63 in your limit order and
Yeah,
ride it out.
if you wanted that one, or
Yeah.
I'll go find something now. Now, in this case, I don't see a deal here. So,
Yeah.
like we just said, we'll pull out and go to a different expiration.
Mhm.
This is optimizing your profitability. Does all that make sense?
Got it.
Mhm.
Diana, did I answer your question on the
You certainly did. Thank
theta?
you so much. Yes, you did. Thank you.
All right, so yeah, this theta right here, man, like I said, they get expensive. So theta comes off each day. So like if I got in a play today, no theta's involved. If I didn't sell it, as soon as the market opened up the next day, that the value of that theta comes off, and then you're looking at your contracts for the remainder of the day. Now, if it's in consolidation and the stock price didn't move, that means you didn't make no money. Boom, the market closed, you come in again the next day, theta come off.
And that's per contract, right?
Yep. Per 100. What's good, Joshua?
Now, what is that where
What
I
up?
know with the time decay, the closer you get to expiration, does that theta start decreasing faster?
Exactly.
Mm,
So you really need your stock to start performing.
yeah.
So like I said, people trying to hold till expiration. I mean, if you up, yeah, you can do that. But if you down, it's just going to take more for the play. The stock
To
price needs to
recover.
go up in order for you to get some good theta. So that's that delta to theta ratio.
Fabian, was that option chain in your brokerage account? Is that from your brokerage account?
Yes.
Okay.
And I use Charles Schwab.
I use Fidelity and mine looks nothing like that. So I have to figure out what I'm just.
Yeah, that was a work in progress. Setting up all your rules and opening up
DC, I
those
got
different
Fidelity,
tabs.
so you could just ask me. I'll show you.
Okay, cool. Thank you, Joshua.
So with that being said, if we got a little more clarity and understanding on Greeks, hold on, let me get Sheila's message. Yep, I divided the 52-week high by 2. That's cut in half. And like I said, I'm doing that because I'm looking for more upside to get back up to that 52-week high, if at all possible. That just lets me know I got more room for my premium to grow. Because at the end of the day, your premium is your money. Your premium is your money. That's how you get paid. Did I answer you, Sheila? Yep, 52-week high divided by 2. You don't have to wait for that price. That's just good math and a better probability setup for you. Keep in mind, before this rule, everybody was jumping in trap plays just like that. And those premiums were high. I mean, you still made money, but if you'd allowed the premium to come down, you could have put yourself in a more profitable situation. So that, to me, kind of gives you the idea of how much profit you can get out of the play. We all looking for 100% or more. By your premium at a decent level, you probably bought in where you can only get 50% off the play. And that's based off the 52-week high. Could it go higher than the 52-week high? Yeah. But right now, we don't know that. So all we're going to do is go off what the high is right now, divided by 2, and make that our basis for a good premium price to pay for that particular play. You can do that on any premium delta. All right, we was deep in conversation there, but did we get some writing done? What is going to be your rule of thumb for your delta? You're going to get in 50 cent, 80 cent, 40 cent. What does that theta look like for you?
What's a good theta? What would you say a good low or high theta would be?
If you get in a play with a high theta, you need to
Run.
you need to be in that play when it's guaranteed to go up. You almost got to hear everything go right in a line.
What's considered a high or low theta though? Like what's a good measure for a theta? What's a bad, like, oh, that's too
Yeah.
high.
Well, it depends on the play.
Yes.
Like I just pulled meta up. Let me go back to that. So these thetas is ridiculous. Well, I just showed y'all meta. I did run another one. I'll pull that up, which is SoFi, much cheaper. So you can see the difference.
I'm in SoFi, yeah, so that's a good one. Let's see what.
All right. Now see this theta, 45 cent. I mean, theta, 54 cent. Delta, 45. The theta is higher than the delta. Now, once again, the theta only comes off every day. So if you get in at this price, 45 cent, the next day or the time you get in, you need the stock price need to be moving. So this 45 can start turning into 50, into 60, into 70. Because you ultimately you got to get above this to really make some money. So that stock price needs to move. Time you get in this play, you already behind. See that? The theta is higher than the delta. You're already behind.
Okay. So that makes me wonder if because I'm not familiar with, I mean, I know that theta is there, but I've never knew how to use it or how it plays a part. I knew it was important, but I just didn't know how. And so that makes me wonder if that's why almost immediately when you enter into a play, you look and you like, God damn, how am I down $3 already? Because I've never paid attention to the theta. So I'm wondering if that's why.
I mean, the theta doesn't hit you when you first jump into play. But if you jumped in and your premium was 45 cent, it's based off the current stock price. See, right now the stock price is 727. And this premium is based off of that. So this 727 dropped down to 725. Boom, you're going to lose some delta. That 43 going to turn into 42 or something like that. So it is really about the ratio versus what's a good theta, what's a good delta. It's the ratio. And like I said, this ratio here is upside down.
Okay,
But
got it. That makes sense.
boys with, big money jump into these. But I wouldn't jump into these in no shape, form, or fashion. And that's 30 days. Now you come down here, it just gets worse. But that's because of 30 days. Remember, we was talking about your theta speeds up. That's what happened here. The theta is higher and your delta is lower. Now, people that was already in this play, this is what they get being affected with now. Delta speeding up. See, you don't even want to enter this. There's people that was already in it should be getting ready to get out. Now, let me pull up SoFi, much cheaper.
Okay, so if my delta is 60, my theta should be at least like 30, half of that or lower.
I go lower. I go lower than that, bro.
Lower than that.
If I jumped in something like this, the momentum is already moving, like Tesla.
Okay.
if Tesla at 440 and the thing is just moving, because Tesla go from 440 to 600 like that, and then you can just jump in and catch that wave. You ain't got to sit in it long because it's moving, and you caught that delta and you caught it going up despite the theta. But that's day trader behavior.
Yeah, I ain't on that.
All right, Diana, can you see my screen? This is SoFi options chain. Much cheaper. Looks so much better. So here's our delta column. 42 cents. Look at the theta. 3
That's
cents.
crazy.
See what I'm saying?
That's crazy. Yeah.
It depends on the stock. And see, 3 cents, it's not much, but if you sitting in this play for a long, and see, this is 30 days. I've been getting ones out to 2027, and these thetas are like 0.001.
1 cent.
Yeah. So I can sit in them longer without losing value, but I got so much upside potential. This thing is just gonna be sweet. So if you got those long contracts, but yeah, I forgot who that was. Asked me about what's a good theta delta ratio.
Yeah.
Any of this is good. But if you get up here, 54 cent versus 3 cent, 26 cent versus 2 cent, all that is still good. Because even though you buy down here, eventually, if the stock is moving, your 26 is going to turn into 54. So we just left Meta, and some of the plays was $7,000-$8,000. And if you're okay with spending $7,000-$8,000, you should come. But we also looked at the premium, right? And we said that the premium was not on sale. You come over here to SoFi, all these premiums are on sale based off of my divide by 2 math. This $29.50, right now the low price is $119. The high was $232.
Mm.
116.
Yeah, 116.
So it just needs 3 more cents, and then it's on. I mean, I would get it at 119. I wouldn't be tripping. But 116 is half of the 52-week high when it comes to the premium price paid. So you can definitely come over here and get a much better deal. Much better deal. And if you want to spend $7,000 for one contract, you can come over here and spend $7,000 for about 20 contracts and watch that thing run up, and you can get the same amount of money. Returns, rather. So that's how I shop, man. You got to play with your numbers, man, see what works. But yeah, ultimately, delta theta ratio, if you can get this, now your Teslas and all that, you won't get this. But you still want some type of separation in there. But this here is great separation, bro. 31 versus 3 cent, 48 versus 3 cent. And there are stocks in there like that: Walmart, SoFi, APLD. All those stocks like that have that low theta. Now, like I said, like Belinda said, with the Teslas and the Metas and all those, if you get into those delta to theta ratios, yeah, they're out of whack. But you're looking to get into those when they like running. You ain't trying to get in there and sit a day or two and wait for it to pop. That thing need to already be popping, and you jump in while it's popping and catch you some momentum to the upside when you dealing with deltas and thetas like that. How we love that.
Mm-hmm.
I like that because I think it's a reminder to just paying attention to the characteristics of the different companies because they do all move different.
Yep, for sure. Now SoFi is slow. SoFi been slow for it. Just started moving.
Man, tell me about it.
It just started moving. But you can be patient with these type of thetas. You can be patient with those. You just don't want to get in and it start going down. But if you can catch it right at the bottom and it moves $1 a month, you're making money. You're making money.
Yeah. My contract is out until March, so I got time. I'm just watching that thing go up, drop down, go up, drop down. It's pushing up, but yeah, it's a slow process. Slow stroking that thing.
Davian, are you still in Cabo?
I am.
Painful.
It is painful.
You
But
know
I'm
what?
I ain't getting out, but it's pain.
I can say it's
now,
painful, but to be honest with you, I'm not even looking at it.
I need to
Mhm.
stop looking at it.
It just so much other stuff going on. I done been in and out of other things. Now that Kava's still sitting there, you know, down 25, 30%. It'll get down to 20, then boom, jump back up to 30. But I got a 2027 on that one, so I ain't really tripping. Like I said, I don't
It's
even
gonna
look at
take
it.
that long. It's gonna take that long, probably.
No. It gonna come back. People gonna get hungry.
November, they're gonna start shopping for Christmas.
Yeah,
Go out.
for sure. Question number 6. Moving to the next one. Risk versus reward. This is kind of like what we were discussing there with the deltas and the thetas, your risk to reward. Basically, how much money are you willing to lose to make a certain amount of money? Are you willing to lose $100? Are you willing to lose $200? But if you're willing to lose that, what are you looking to make? So that's where you get your risk reward, 1 to 1, 1 to 2, or 1 to 3. You really want to be in the 1 to 2, but 1 to 3 is golden. So you're saying for every $100 I spend, I want to make 300. For every $100 I spend, I want to make 200. Risk to reward. And the one is what you're willing to lose. I did this the other day. Matter of fact, it was with the AVGO. I jumped in there with Belina and never did this before, but I knew the thing was moving. I picked a 3-day expiration. And I said to myself, because me and her got this thing going on, growing small accounts. So I started out with $300. So you don't want to blow your account. That's where all this discipline comes in at. Now I'm practicing this discipline that I'm telling y'all about. So I got the $300. I don't want to blow the account. So I spent $21. I said, I'm willing to lose $21, but I should be able to make 40 or 60 on the back end, my risk to reward. So boom, I put that 21 in there. I came out with about 80. So I didn't do 1 to 1. I did like 1 to 2. And if I'd have held a little longer, I could have got 1 to 3. But I got out at 1 to 2 because it just moved so fast. But yeah, that's that risk to reward. How much you're willing to lose to make what you're trying to make.
So was
You
that
could
like a
lose.
30% profit?
No, that's like 200%,
Oh, 20%.
300%.
Okay.
So, 100%, if I spent 21, it would have been 42 when I would have cashed out. That's 100%.
Gotcha.
So like Nisi, she got her 200% 2 or 3 times. So you just want to establish your risk to reward.
That's good, Davian. That's real good right there.
And this goes back to question 7, like we did yesterday, our discipline anchor. When things get rough and you get tested, what are you going to write down that's going to get you back on track? Almost like an affirmation, quote, anything like that that's going to keep you disciplined and on track for your goals. I still use the sticky notes. I like to put notes in my phone. Sometimes you just want to walk away from the computer. I can see Belina doing that. She's sitting there all day watching them candles run 100 miles an hour. Things start getting a little shaky, a little turbulence. She got to go to the break room a minute, clear her mind, come back and look at those candles again. Might see something different. What are you going to write down? What's going to keep you motivated? Or you can go back to Trap's mantra. All that still works here. Getting those last minute ones in. All right, in closing, motivational quote from a man, Warren Buffett. Successful trading is about consistency, not intensity. Small disciplined steps build lasting results. Marathon. Take things slow. Like she was saying, you know, start out with the smaller plays. Eventually we will get up to the bigger plays. That's your risk to reward. If we playing with 20K and you playing 10% of that, even though you don't turn that 20K into 50K, you still want to go back down to your 20K and play it again. You're still going to continue to build, but you're building everything off of that 20K. That's a start. Trap said it best in one of these Trapping Tuesdays. I can contest to that. You could have 5 good plays. You know, when you initially start out, you buy one contract, 100%. Buy another contract, 100%. Buy another contract, 100%. You done did that 5 times, and you got 100% off all of them. So now you decide to scale and go big, and you buy 5 contracts, and the play go left. Meta 505, that happened with me.
That hurt.
Yep. So sometimes you just want to, hey, if that one contract was working, just keep it going until you get to so much, and then try to scale up. Any questions or concerns? We'll go ahead and close it out, and we'll be back here tomorrow for day 3.